Said you should confirm if you can hear me or see my screen. You're the one I'm waiting for. Nobody's saying anything.
We can hear you. And
We can hear you.
Okay, all right. So you're welcome this evening. So today now we'll be moving to a new topic on financial instruments. So last week we were able to finish up with IAS 19 on employee benefits. So today, hopefully, we'll go far on financial instruments. And I can remember that I gave you assignments on employee benefits. As far as I can remember, none of you submitted. So I hope you have done it. I think you have the solution with you in the note I shared. Since nobody sent it, that means it simply means you all understand it, which is good. So today now, we'll be starting a new topic around financial instruments. And this topic, going straight to the point, we are going to be looking at two standards to take care of this topic. One is we're going to look at IAS 32 to look at this. So what IAS 32 would do for us majorly, it would make us understand what financial instrument is, looking at the objective and scope, the classification of financial instruments between liabilities and equity, and also IAS 32 will also help us with something called compound financial instruments. So basically, those are what we will look at in IAS 32. Beyond that, we would also look at IFRS 9 on financial instruments. Majorly, a lot of people call it financial instruments, recognition, and measurement. So this standard, what we'll be looking at there are, we'll look at recognition of financial instruments. We'll look at derecognition of financial instruments. We'll look at measurement of financial instruments. We'll look at impairment of financial instruments. And there's also hedging, which we are not going to look at, is not within the ICANN syllabus. It's not something we're going to look at. And there's also IFRS 7, which we are also not going to look at because it's not even within the scope of this exam. So hopefully, I hope to go far today, but I know we can't finish all of this today. But majorly, we are going to round it up next week. Next week will be the final class on financial instruments. So let's see how far we can go today. So the first thing I want us to look at is for us to, let's go straight to understanding what financial instrument is before we then spread our tentacles around other things you need to know. So let's go straight to the point. Looking at the definition of certain terms, and this definition of terms are majorly from IAS 32. So yes, it's actually IAS 32 that helped in defining all these terms. So the first term we'll need to understand is what is a financial instrument. And according to IAS 32, it said that financial instrument is any contract. Financial instrument is any contract that gives rise to financial assets of one entity and a financial liability or equity instrument of another entity. This is the definition given by the standard, which you also have to know. So looking at this definition, the first thing here is that it says financial instrument is a contract. That's the first thing here. So what we call financial instrument starts with the existence of a contract. And when we talk about a contract majorly is just an agreement between two parties. And this agreement doesn't necessarily have to be in writing. It could be an understanding. Now people sign agreements electronically, but what is important about this agreement is that it must have clear economic and legal consequences, in the sense that if a party does not fulfill his own part of the deal, it can be sued, or it can be penalized, or you'll be asked to pay certain amount of money. I mean, that makes it a contract, because every party must do what they are supposed to do. So first thing about a financial instrument is that there has to be a contract. That's extremely important. Now, you see, this contract we are talking about will now give rise to a financial asset of one entity and a financial liability or equity instrument of another entity. So what we're saying is this: when you have a contract, there must be at least two parties. Here, two parties minimum. It could be more than that. So for there to be a financial instrument, or for a contract to be a financial instrument contract, a party must have a financial asset. A party must have financial asset. And the other party would have either a financial liability or equity instrument. When that happens, then that contract is a financial instrument contract. So a financial instrument is a contract that gives rise to a financial asset of one entity. One entity must have a financial asset. And a financial liability or equity instrument of another entity. Another means that another entity must have either a financial liability or equity instrument. So to get more clarity is that there are the additional three terms we need to look at from this definition. Let's understand what a financial asset is. When we say the party must have a financial asset, so let's look at what a financial asset is. We would also look at what a financial liability or equity instrument is. So when we understand those three, then we'll look at some examples of financial instrument contracts. Then it's going to make more sense for us when we understand the entire elements affecting a financial instrument. So what is a financial asset? Okay, I am back. I think I went off briefly. Okay. All right. So I'm sure you can see me and hear me clearly now, all right? Yeah. Okay. As I was saying, so I was trying to look at a financial asset. So a financial asset is first thing is that it is cash. That's the first thing. Then the second is that financial asset is also an equity instrument of another entity. Equity instrument of another entity. In the sense that if you buy shares of a company, like when MTN came out, a lot of youths bought their shares, and I'm sure that some of you might have shares in a company. So if you have shares of a company, if you bought their shares, automatically you're a part owner of that company. But what you have done is that you have invested. You have invested. And that investment you have is a financial asset. So financial asset is an equity instrument of another entity, meaning that you invested in shares of another entity. It's a financial asset too. And thirdly, financial asset is a contractual right to receive cash. A contractual right to receive cash. So when we talk about contractual right to receive cash, what we mean is that when you have that right, you do little or nothing to receive that cash because you will just have to get that cash. You don't have to do anything. Contractual right to receive cash. And what can give you this contractual right to receive cash is majorly when an entity lends someone money or lend another person money. For example, now, government recently issued, Nigerian government, recently issued some treasury bills. If you had bought some of those treasury bills, automatically you have a contractual right to receive cash because the government would have to give you interest. They would also give you your principal at maturity, and it's fixed. You know when you're going to collect what. So typically, that gives you a contractual right to receive cash. Another one that is relevant to us for your exam is trade receivables, which arise when you sell on credit. You have a trade receivables. Trade receivables also gives you a contractual right to receive cash. When you have a contractual right to receive cash, it is an investment and it is a financial asset. Now, there are these other parts of this definition. You might, at this level, I can't really, will not ask you to start defining anything. These other parts is beyond our scope here. So I won't really be going so much into it. So financial instrument is wide, but we have a very restricted scope for your ICANN exam. So that's this other part or another financial asset from another entity, or to exchange financial assets or financial abilities with another entity under conditions that are potentially favorable to the entity. This speaks to some other complex financial instrument transactions that are beyond our scope in ICANN exams. Okay, so speaking from experience, we're going to focus for your exam when understanding what a financial asset is. What I need you to remember is these three things when it comes to financial asset. One is that you need to understand that financial asset is cash. It can be cash. Secondly, is that when you invest in shares, when you buy shares in another entity, that is what we call an equity instrument of another entity. That is also a financial asset. And thirdly is a contractual right to receive cash. That's the third one. So at your level here in this ICANN exam, any other thing beyond these three would not be a financial asset. Would not be a financial asset. Okay, so, and there are some examples here, like trade receivables, lease receivables, equity instrument of another entity, check, bonds, and all of that. Okay, so just for me to confirm that you understand what I'm talking about. So let's look at property, plant, and equipment, like a motor vehicle, for example, now, a motor vehicle. So based on your past learnings, you should know that motor vehicle is PPE, is a property, plant, and equipment. But looking at it, relating it to what we are learning today, financial assets, being cash, investment in shares, and this one, contractual right to receive cash, is majorly investment in debt when you lend somebody money or when you sell on credit. But the question is this: can motor vehicle, if you buy a motor vehicle, can it be a financial asset? So I know that it's not cash, it's not shares. It's not like you're buying shares in a company. So But is this third one I'm looking at? Can motor vehicle give an entity contractual rights to receive cash? Because if it can give an entity contractual right to receive cash, then motor vehicle can also be financial asset. But not to waste our time, right? Motor vehicle does not give an entity contractual right to receive cash, because for you to have a contractual right to receive cash, it means that you would not have to do anything to get that cash, because you had only invested. You just need to invest, the money will start flowing in. Somebody will have to pay you, even if, because it's a contractual right, which means that if you don't get it on time, you can sue. There will be legal consequences on that other party. But motor vehicle, if you have motor vehicle and you sit down and you don't do anything with it, you will not get anything. You will not get anything. That is why physical assets like motor vehicle, like in fact, PPE generally, even in some most intangible assets, they are not financial assets, because you need to work. You need to use them for something before they can generate future economic benefit for you. That is why they classify those ones as PPE or intangible asset, as the case may be, because they are held for use for either production or supply or rentals or admin. So they are different from financial assets. Those ones only gives you an opportunity to generate cash, meaning if you use it very well, you will generate cash, you will receive. But if you don't use it, you will not generate anything. That is different from what we are talking about here, contractual right to receive cash. This one, you don't have to do anything. In as much as you have invested, you have lent some of the money, just go and rest. Money will be flowing in. They will give you interest. You will collect back your principal at specific date. So that is a financial asset. The second one is a financial liability. And again, the focus for financial liability is that financial liability is any liability that is a contractual obligation to deliver cash. It's just like the flip side of this right to receive cash, which is one of the definition of asset. Liability is obligation to deliver cash. So this other part, I won't go into it because nobody is going to ask you this in your exams. You can also look at it. So don't really, except if you just want to cram this definition for what about, it's not an area I would want to go into with you. So examples of liabilities that I have is like your trade payables is a financial liability, because when you have a trade payable, you have an obligation to deliver cash. Notes payable, similar to loans payable, bonds payable, or a lease liability. If you lease an asset, you are supposed to be paying rentals to the person. So you have a lease liability. You have an obligation to deliver cash. Now, when it comes to obligation to deliver cash, you have to be very careful. That to deliver cash is extremely important, because it has to be cash you are delivering, nothing else. So if, for example, you give me money, let's say 5 million to buy a car, and that car, I told you that you are going to get it in the next 6 months, but you are giving me, because you know that that is what I do as my primary business. I sell car. Now, according to IFRS 15, which we are still going to look at in this class, when you give somebody, when I collect money from anybody for an item that I sell and I have not performed or have not delivered, I cannot recognize that money I've collected as revenue, because I have not performed according to IFRS 15. IFRS 15 says that kind of money you collected, recognize it in your books as a deferred income, meaning a liability. is going to be a liability in your books because you have collected money to deliver, but you have not delivered. So I cannot put it in my books as revenue. Rather than crediting revenue, you have to credit a deferred income, which is a liability. Because why is a liability is that since I've not performed, you could actually come to me and say that I should return your money. So it's a liability, right? Now, where I'm going is this. Can we classify it under a financial liability? Is it possible to classify under a financial liability? To save our time again, no, we cannot classify it under financial liability because the obligation I have is to deliver goods to you, not cash. What I'm going to deliver to you is a car, not a cash. So those kind of liability where your obligation is to deliver goods or services, you cannot classify such as a financial liability. Rather, it's going to go there as other type of liability because a financial liability is an obligation, a contractual obligation to deliver cash. Finally is equity. I have defined equity before now under conceptual framework. So equity majorly is generally share capital, specifically ordinary share capital, and your reserves. Reserves like share premium, retained earnings, revaluation reserve, and others. That is your equity. But by definition, in this standard, it said equity is any contract that evidences residual interest in the asset of an entity after deducting all its liabilities. We have seen this definition before when we looked at conceptual framework. Is a residual interest, meaning that the interest in an asset meaning whatever returns you are getting from this asset is these guys that are residual. They are the ones you consider last. Majorly, those are ordinary shareholders, and that is equity. Okay, now, still looking at the definition of a financial instrument, we have looked at the three elements in that definition. Remember, the definition is that a financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. We have looked at what a contract is. We have looked at what a financial asset is. We have looked at what a financial liability is. And we have also looked at what an equity is. Now, having understood those elements, then we are now right to look at some examples of a financial instrument contract. Now, the first example I will look at is credit sales, not cash sales. I'm looking at credit sales. And when you sell on credit, it is a financial instrument contract because it will give rise to financial asset to the seller. That is a trade receivable, and gives rise to financial liability to the buyer. That financial liability is trade payables because the buyer has an obligation to deliver cash, while the seller has a contractual right to receive cash. So a credit sales transaction is a financial instrument contract because those two sides are present. There are two entities. One entity has a financial asset and another entity has a financial liability. So the two sides is complete. There has to be one entity having a financial asset and another entity having either a financial liability or equity. Just that in this situation, it is a financial liability. Since those two parties are present, then it is a financial instrument contract. Another example is bank savings or bank deposits. When you deposit money in the bank, your account gets credited. So you have cash or bank. That is a financial asset to you because you have a right to receive cash. In fact, it is cash. That is cash for you. The bank has an obligation to deliver that cash to you whenever you need it. So the bank has a financial liability. The two side is complete. Bank savings gives rise to financial asset of one entity, who is the depositor, and the financial liability of another entity, who is the bank. Next one is a loan transaction. When you go and borrow money, either from the bank or from other sources, anywhere you are borrowing the money. When you borrow money, you would have a financial liability, which is a loan payable. That is, if you are the borrower, because you would have a contractual obligation to deliver cash in form of interest and repayment of principal. You see, the lender, that guy is an investor because he has invested in your debt instrument. He has lent you money. That guy automatically has a loan receivable that gives him a right to receive cash. That cash you are looking at here is interest and principal. So a loan transaction is a financial instrument contract because these two sides are complete. It has given rise to financial asset of one entity and financial liability of another entity. Next one is a lease contract. When you enter into a lease arrangement, it is also a financial instrument contract because it gives rise to financial asset of one entity in the form of like a lease receivable. When we look at IFRS 16 from next 2 weeks, you will see that we also call this lease receivable net investment in the lease. That is a financial asset because it gives you right to receive cash. The other guy, who is the lessee, that guy has an obligation to deliver cash. So he has a financial liability. So a lease contract is a financial instrument contract. Another one is treasury bills or bonds, like the ones CBN or federal government just issued recently. That is also a financial instrument contract because it gives rise to financial asset of one entity, who is usually the investor. The investor will always have a financial asset because you have a right to receive cash from the government in form of interest and repayment of principal. And also the government has a financial liability because the government, being the borrower or the issuer, they have an obligation to deliver cash. The two sides is complete again. So this is also a financial instrument contract. Another one is an ordinary share transaction. And an ordinary share transaction is, for example, if you want to start a new business and you want people to invest in your business, not just investing, but to be like a part owner of your business. Usually you will issue out shares. You will issue out shares to them, usually in form of ordinary shares. Now, those ordinary shares in your books, you simply put that in your books as share capital. It is a share capital in your books. You see, those other investors that has given you that money or that believe in your vision and invested in your business, those guys, they now have equity instrument of your entity. Don't forget, that's one part of the definition of a financial asset. A financial asset is an equity instrument of another entity. So if you buy shares of a company, if you purchase shares of another company, you have an equity instrument of that company, which is a financial asset. So ordinary share transaction is also a financial instrument contract because the two sides are complete. It gives rise to financial assets to the investor or to the buyer, the guy that invested in your company. And it gives rise to equity instrument to the buyer. Not all. It's equity instrument to the buyer because the buyer now has an equity, sorry, not the buyer, the issuer or the guy that is starting a business, they would put it in their books as a share capital. So they would have an equity instrument. So really, that is the entire story around the definition of a financial instrument. So as far as I'm concerned, this is a very important area. Understanding this definition is extremely important. So several diets, I kind of tested these areas for 15 marks or for 9 marks. Majorly, the last one they tested on this area is 15 pure marks. Just trying to understand whether you understand, just trying to see whether you understand the definition of a financial instrument contract. So before I move away from definition, then going to other parts of financial instruments, I would like to test your knowledge with these questions. There are 8 questions here, and unfortunately for us, you are not up to 8. That means the question will not go around, but every person in this class must take one and answer. So what does this question want us to do? They said the following relates to Net Worth PLC for the year ended 31st December 2021. So they gave us transactions of net worth. We are now required, let me go to the requirement straight on. We are required to determine whether the item above are financial assets or financial liability. And you are also expected to state whether a financial instrument exists as at 31st December 2021. So you need to tell us, is it a financial asset or a financial liability, and whether a financial instrument exists. So let's start with the first one. Net Worth owns cash. Net Worth owns cash of 5,000. So I'll just call you in alphabetical order. So, and don't waste our time. If you know it, just talk. If you don't know it, say you don't know it, so we can move forward to another person. So Net Worth owns cash of 5,000. So what I just need you to tell me is whether Net Worth has a financial asset and whether a financial instrument contract exists, right? So let me start with Zainab, because your name is showing first here. If you're in a noisy area, you can just type your answer so that it will not be distractive for us. But if you can talk, just talk. Zainab, are you there?
Yes, I'm doing homework here. I didn't really concentrate, sir.
Okay, no problem. So let's move to believe, right? So believe, hope you're not doing homework. So.
Okay, there is a financial instrument because of the cash.
Okay, so I need you to tell me first, net worth, is it financial asset to net worth or financial liability or equity?
It's a financial asset.
Okay, that's correct. So secondly, I need you to tell me whether a financial instrument contract exists here.
Yes, because there is obligation to receive cash.
From who?
That's a
There is no financial instrument contract here because, yes, you are correct. Net worth has cash, which is a financial asset, right? But for a financial instrument contract to exist, the two sides must be complete, meaning there must be another person that has either a financial liability or equity. And in this case, is cash. Since they didn't give us complete information, I'll just see it as cash in hand. Just like you have cash, you have cash in your office. Nobody has a financial liability or equity. So there is no financial instrument contract here. There is no financial instrument contract here. So that closes that. Okay, so let's move to the next one, and that will go to Jolade. So this one says that net worth owns a demand deposit of 1 million with First Bank. So what I just need you to tell me is just that, does net worth has a financial asset or a financial liability? First, you need to tell me that first.
Okay, so net worth has a financial asset.
Okay, that's correct. So is there a financial instrument contract here?
So, yes, there's a financial instruments contract. It's a financial liability, I guess.
Okay, so that means you are saying another person has a financial liability. So who has financial liability now?
So I think it's with what's the demand deposit? I think it's First Bank. I'm not sure.
Okay, that's correct. So yes, net worth owns a demand deposit of 1 million with First Bank. Demand deposit is just you gave First Bank money that, okay, keep this money, I don't want to touch it for the next 1 month. So that's cash to you as net worth. So you have a financial asset. First Bank has an obligation to deliver that cash to you when you need it. So First Bank has a financial liability. So that means the two sides are complete. There is a financial asset of one entity, and there's a financial liability of another entity. So there is a financial instrument contract. Okay, so let's go to the third one. That will be Maya, because your name is showing next here. So net worth statement of financial position includes 2.5 million shares of Google. So Maya.
Hello. Good evening.
Hi, how are
Okay.
you?
Okay. I think it's a financial asset.
That's correct. Yeah. So net worth has shares in Google. So that's correct. That's an equity instrument of another entity. So the second part is there a financial instrument contract?
Yes, because the liability to the company, but an asset to net worth.
Okay. So you're talking about is a liability to Google?
Yes.
But you know that this one is shares now. This is shares now. So that cannot be a liability to Google. That would be an equity to Google. When a company issued shares and you buy their shares, yes, fine. Me that I bought the shares have a financial asset.
Yes.
But Google, in his book, he will just put it as share capital. Share capital is not a liability. Share capital is an equity. So what Google has is an equity, not a financial liability. Yeah. So you are correct. There is a financial instrument contract, but the other party in this case has an equity instrument and not a financial liability. So again, the two sides are complete. So I hope you get this one right. A lot of students usually miss this one, and I don't know why. So in fact, this is the only instance where the other party will have equity, where what you have invested in is shares. So when net worth buys shares of another company, yes, net worth has a financial asset, but that other party has an equity instrument, not a financial liability. And I hope you also know that I gave you an example that if you start a company now and you now call people to come and buy your shares, in your books, you simply have share capital. Share capital doesn't give rise to obligation to deliver cash. No, you don't have to give anybody. In fact, when you have shareholders as a company, you don't have to pay them dividend. It's conditional. You don't have to pay anybody dividend. Even if you make profit, you can decide that you are not paying, that you want to reinvest so that is extremely different from liability. So always be on the lookout for this. The other party has an equity, not liability. Okay.
Okay, sorry, but there's a financial instrument, right? Just that it's an equity to
Yes,
Google and an asset to network.
exactly.
Okay.
Exactly. That's correct. Okay, so nice one. So the next one is going to go to Omotayo because your name is coming next. So this one says that net worth statement of financial position includes inventory of 56,000. So, Omotayo.
Okay, good evening, sir.
Hi,
So
Omotayo.
inventory is an asset. So it's net worth has assets of 56,000 financial
Okay,
assets.
okay, financial asset. Okay, so is there a financial instrument contract here?
No, there is no contract. Since
All
there
right.
is no other party. There is no other
Okay.
party in the question.
Okay, that's correct, but net worth does not have a financial asset. Inventory is not a financial asset. Inventory is one. If you look at the definition of financial asset is cash. Inventory is not cash. The second definition we gave is that financial asset is equity instrument of another entity, which means that you bought shares in another entity. So inventory is not shares in another entity. The third definition is that financial asset gives you contractual rights to receive cash. Inventory doesn't give you a right to receive cash. I told you, right to receive cash, you don't have to do anything. Money will just come in. Money will just come in. Inventory, if you don't do anything, you won't sell. You have to make efforts. Some people even pay, advertise, do all sorts before they can sell. So inventory is not a financial asset. Inventory is an asset, fine. But inventory is inventory under IS2. Inventory. It is not a financial asset, right? So, yeah. So, I mean, that means it is not a financial instrument contract either. Omotayo, is that clear? I want to
Yes,
believe
it is.
so.
Thank you, sir.
Okay, now, Amaka, Prosper, so you go next. Say net worth sold goods amounting to 55,000 to Laye on credit. So I need you to tell me, does that give net worth a financial asset or financial liability?
Okay, good evening, sir. I think financial assets, sir.
Okay. What do we call that financial assets? What's that financial?
Receivables.
Okay, that's correct. That's perfectly correct. That's trade receivables. Okay, good. So the next thing is that, is there a financial instrument contract here?
Yes, sir, there is.
Okay, which is?
The Lay Limited is a financial liability to them that are obligated to pay cash to net worth for the event, for the goods sold.
That's correct. So which is a trade payables, right? That's
Yes,
correct.
sir.
Yeah, nice. Good. So net worth has a financial asset, and there is a financial instrument contract because Laye has an obligation to deliver cash. Okay. Okay, that's everyone. So I'm going back to the first person. So I can't call Zainab because she's doing homework. So let me go back to Believe. So you're going to answer the F. So on 31st December 2021, net worth received an advance payment of 250,000 from one of his customers, Muri Limited, to deliver goods in January 2022. Believe, are you there? I know. What's your name, Gongon Believe? I'll call you. That's not your name. Okay, I guess she's not around anymore. So let's move to Jolade. Jolade, answer that. Okay, I guess she has left too. So let's go to Maya. So I know your name is not Maya. Your name is Mirabel. So Mirabel, do the next one.
That's F, right?
Yes.
Mm, okay. So it's an asset to net worth.
Okay.
That is an asset or
Which is a financial
prepayment. I
asset?
don't know the particular word. Yes, to net worth.
Okay.
And
Is
I
there a
think
financial instrument contract?
no.
Okay. So I think I've explained this to you before that you net worth received an advance payment of 250,000 from one of his customers to deliver goods. This is similar to the example I gave that if I collect money from you to buy a car for you, that that money is a liability in my hand. And I told you that it is not a financial liability because I have an obligation to deliver that car to you, not cash. So net worth here does not have a financial asset. It's far from asset. It's not even asset, right? What it is it's a liability, but it is not a financial liability because what net worth has to deliver now is goods, is to deliver goods to Muri. And here too now, that means since there is no financial liability, that means the two sides can never be complete. And what Muri is even expecting is even goods, not cash. So there is no financial asset, there is no financial, it's another type of liability and assets that there is here. So net worth does not have a financial liability, and there is no financial instrument contract here. And that settles that F. I don't know. Did I communicate? This is like the second time I'm giving an example
No, I don't
like this.
understand.
Okay, let me go over it again. So, like I mentioned earlier, net worth received an advance payment of 250,000 from one of its customers to deliver goods, right? So I've mentioned it before that when you collect money to deliver goods, meaning that you have not delivered, you cannot put that kind of money in your books as revenue. We put it as a liability. And the key point here is that this liability, can it be a financial liability? No, it cannot, because financial liability is a contractual obligation to deliver cash, not to deliver goods. Okay, not to deliver goods. So since what net worth is delivering here is good, so it is not a financial liability. So that means we don't have a financial instrument contract here. And that's what we are saying. I don't know if you now understand it.
Yes, I do.
Okay. Now, the next person here is, again, Omotayo, back to you. So, net worth statement of financial position. Statement of financial position includes a current tax liability of 5,000 as well as a deferred tax liability of 6,500. Okay, so the main question is that current tax liability and deferred tax liability, are they a financial liability? That's
Yes,
the question here.
yes, financial liability, because they have obligation to pay the tax.
Okay, that's correct. Yes, what is correct in what you have said is that, yes, you have an obligation to deliver cash because you have to pay the tax. That's correct. But the funny thing is this, you don't have a contractual obligation to deliver cash. You only have an obligation to deliver cash. So paying tax is not like you have a contract to the government. It's just your civil responsibility as a citizen of Nigeria, or as somebody operating business in Nigeria. You have to pay tax. So there is no contract here. And for that reason, tax liability is not a financial liability, majorly because we don't have a contract. There is no contract. So current tax is not a financial liability. It's just current tax, according to IAS 12, not a financial liability, because there is no contract to the government. Deferred tax is that one is even clear, because deferred tax does not give rise to delivery of cash, because you are never going to pay it anyways. Deferred tax is just an accounting measure to match accounting with tax, right? It's just like an accrual for tax, like that. So deferred tax is not a financial liability, because you don't have an obligation to deliver cash. You don't have a contractual obligation to deliver cash. Okay, so it's quite very clear in the standard. They were very specific about current tax or tax liability generally, that they are not financial liability, majorly because there is no contract with the government. You don't have a contract with the government. Okay, I hope I communicated. I mean, the main point there is that you don't have a contract with the government. Yes, it is a liability, but there is no contract. There is no contract to deliver cash. It's just an obligation to deliver cash. So finally, which will go to Prosper again, Network purchased the Bitcoin of 5,000 of 5.5 million. So Network purchased the Bitcoin of 5.5 million. Can this be does Network has a financial asset or a financial liability in this case?
So financial assets.
Sorry, what did you say?
Financial
Okay,
assets.
financial asset. Okay, so is there a financial instrument contract here? Is there another side?
No, sir. I don't think so.
Okay, so that's a good trial. But looking at it deeply, Bitcoin is just an example of cryptocurrency. Is one of the cryptocurrencies. There are other ones like Ethereum, like Dogecoin, like there are quite a number of them anyway. But I mean, they are giving us an example of, they are using Bitcoin as an example here today. So Bitcoin, let's see, can it be a financial asset? Because Bitcoin is not cash. I'm looking at IAS 7. IAS 7 said that cash is a medium of exchange that is generally acceptable. Bitcoin is not generally acceptable, though some people accept it, but it's not generally acceptable. So it is not cash. And cash, according to IAS 7 again, is an item that has an insignificant risk of changes in value. It's not something that changes in value like that. Unlike Bitcoin is highly flexible. Recently, it got to over $60,000 to a Bitcoin. A week or 2 weeks ago, it was like $40,000 for a Bitcoin. Look at $20,000 gain in a week. That is massive. That's highly volatile. It is not cash, right? According to IAS 7. The second one is that financial asset is equity instrument of another entity. That is clear, meaning that when you buy shares in another company, you have a financial asset. Bitcoin is not shares. I mean, so it doesn't qualify there also. The third one on financial asset is that financial asset is a contractual right to receive cash. Bitcoin does not give you a contractual right to receive cash. No. When you go to an exchange, all those guys that sell it, you buy it from them. When you want to get back your money, you need to, there have to be a buyer. You need to sell it, because you're actually selling it to another person for you to be able to have your money. So it doesn't really give you a right to receive. And the funny thing is that your money itself might not be complete again, because as it's highly volatile, your money might have disappeared and you can't sue anybody. It's gone. There's nothing you can do if the value goes down. And it can as well go up, but if it goes down, there's no, so it's not a contractual right to receive cash. So it doesn't fall in any of those definitions we gave of financial asset. So Bitcoin is not a financial asset. It's not a financial asset. So here, Network does not have a financial asset, though they have the Bitcoin, yeah. And there's no financial instrument contract here, since there's no financial asset. But that settles the question. So, however, in March 2020, I can ask the question around Bitcoin for 15 marks. They said they shall give a long story, but the bone of contention in that question is that how should you classify cryptocurrencies like Bitcoin in your books if you buy it? What type of asset is it? Now, I'll explain to you that it is not a financial asset because it doesn't meet the definition of a financial asset in IAS 32. I mean, there's still an hanging element there. Then what type of asset or what class of assets will it belong? Can it be PPE? No, it cannot, because PPE must be a tangible item. So it is not PPE. Can it be intangible assets? Looking at the definition of intangible assets, is something without physical substance, it's something you cannot see or touch. Bitcoin, you cannot see or touch it. So it meets definition of intangible assets. So yes, Bitcoin can be an intangible asset. Thirdly, is that can it also be an inventory? Yes, Bitcoin can be an inventory if you bought it with the intention of selling. I mean, you want to resell it, is your inventory. That's what you deal in as an entity. Like those guys, those exchanges that deal in this cryptocurrency, in their books, those cryptocurrency will be an inventory because their intention is that they are holding it for sale. It will be an inventory to them. So that's the entire story around Bitcoin. But as far as this question is concerned, it is not a financial asset and there is no financial instrument contract here. Okay. So we are done with the first part of what we want to do for today. Now, let me quickly go to the next part of what we want to achieve for today. And the next part is recognition and the recognition of financial instruments. In the past 3 or 4 diets, this is the area ICANN has been asking, recognition and derecognition. In the past 3 to 4 diets. So it was in 2020 they asked this one, this aspect of Bitcoin. So the key thing here is this. Let's start with recognition, right? So financial instruments, whether a financial asset or a financial liability, can only be recognized in the books when the company becomes a party to the contractual obligation of the contractual provision of the instrument. When the company becomes a party to the contract majorly. And if I want to jump here, when does an entity become a party to the contract? Is usually the date of the agreement, meaning the day they signed an agreement, or the date of commitment. Those are the days when they become a party to a contract, either the date of agreement or a commitment date. And that's the first part of what we are looking at today on recognition of financial instrument. Before I go to measurement, let's look at the recognition. But I will start with the recognition of a financial asset. So a financial asset can be derecognized when the right to the cash flows from that asset has expired. Don't forget, a financial asset is a contractual right to receive cash. When those rights has expired, you derecognize it from your books. You remove it from your books. The second one is that when the entity transfers substantially all the reward and risk of ownership of the financial asset to another party. And when we talk about transferring risk and reward, majorly what we are talking about is an unconditional sale of a financial asset. An unconditional sale of a financial asset, meaning that you have sold the financial asset. It's just like you have shares in a company, which is a financial asset to you. When you sell those shares, you derecognize it. Okay? So this second part, this part is talking about, this is saying that unconditional sale. That means, can there be a sale that is conditional? And that's what this B is speaking to. That is, you sold something to a buyer, and you are telling the buyer that, okay, you might want to repurchase it back, but it's going to be at fair value, meaning at market value. Yeah, it's also a sale, though you are putting condition there that you would buy it back or you repurchase it, but it is sale. And majorly why it is a sale is because you are going to buy it back or repurchase it at fair value. If you are the one that is fixing the price, you are going to buy it back. That, okay, I'm selling this thing to you, but I'll buy it back at 17 naira or at 18 naira. That one, you have not sold it. You have not, but that kind of condition is so specific that you still have control over that item. So that's not a sale. But when you have sold, though there is condition, but it's at fair value. It's at fair value. So it's still seen as that you have transferred the risk and reward of ownership to that other party. So majorly, you can recognize the financial assets when your right to receive cash has expired or when you have sold the financial assets. That's what all these are speaking to. Now, the next one is the recognition of a financial liability. The recognition of a financial liability. So a financial liability can be recognized when it is extinguished. When it is extinguished. And what we mean by that is that either when the obligation is discharged, when we say discharged, I mean settled, or either when it is cancelled, or it expires, or maybe transferred. That's what we mean by extinguished. So again, don't forget, inability is an obligation to deliver cash. So as soon as you have delivered the cash, then you are free. Remove it from your books. Or if the person you are supposed to deliver cash to has cancelled it, say, don't worry. Also, again, derecognize it from your book, or it has expired, derecognize it from your books. But there are these things I need you to note about extinguished, right? The first one is this. It's possible to exchange one financial asset with another financial asset. Okay, so when you exchange a financial liability, with another financial liability, that means your financial liability that you are transferring to another party, you have to derecognize that one. So exchange of financial liability can also lead to derecognition. Another one is when you modify the terms of a financial liability, when you modify it, that is, we are talking about maybe you changed maybe the repayment period. Maybe you're supposed to pay in the next 5 years. You said they should give you an extension, or maybe you're supposed to pay interest at 10%. You requested for, and they should make it 5%. So modification can also result in extinguishment or derecognition if the modification is substantial. If the modification is substantial. So, and it is substantial if the cash flow under the old terms and under the new terms, there is a 10% difference in the cash flow. I mean, a simple example is that if you are owing, let's say, 10,000 naira, both interest and principal, 10,000 naira. So you are able to plead for adjustment of interest or period. That's one way or the other, the amount you are owing as a result of that you have modified or changed the terms of the instrument is now 6,000. So from 10,000 under the original terms, now you are now owing 6,000. Now, that change from 10,000 to 6,000 is 4,000. So 4,000 over 10, which is the old value, is like that's 40%. So that change is substantial. So you have to derecognize that old or original terms financial liability. You have to derecognize from your books and recognize a new one. However, when you derecognize a financial liability, it could result in maybe making profit or loss, especially when you are owing somebody 10,000, for example, and they now allowed you to settle for 7,000. That's a gain, that's a gain of 3,000. You are owing 10,000, they say settle for 7. And that 3,000 gain, just put it in your P&L. You can put it under income in P&L. Okay, so those are just other issues you need to know around financial liability. When you exchange one financial liability with another, the one you are transferring or exchanging, you have to remove it from your books. When you modify the original terms of the financial liability, if the modification is substantial, you have to also remove that from your books. Finally, is that when you eventually derecognize a financial liability, you could make a gain or a loss depending on how much you are using to settle. That will determine whether you're going to make either a gain or a loss, or as the case may be. Okay, so that is it for recognition and derecognition of a financial asset and a financial liability. So the next one here is measurements. Measurements. So are you guys still here? Are we still here?
We're still here. Oh.
You don't have any questions? Okay. Now let's go to measurements. So measurement of a financial instrument. So for measurements, we are going to look at measurement of financial assets, measurement of financial liability. We are not going to look at measurement of equity, because measuring equity, I'm talking about your share capital. The way equity is measured is just at your nominal value. The amount you recognize in your statement of financial position for your share capital is at nominal value. So there's no special thing about. So the standard didn't really talk about how you measure equity, because it depends on the country. In Nigeria now, you measure your share capital at nominal value, and this nominal value is usually obtained from the CAC documents. That's where you get your nominal value. And usually, where you now issue your shares above the nominal value, that means there will be a premium, which you are going to recognize in a share premium account. And that is it. for equity. So the focus here is majorly going to be on financial assets and on financial liabilities. So I'm going to start with financial assets, measurement of financial assets. But don't forget that when we talked about financial assets, we talked about, I mentioned that there are three, I gave you three definitions there. The first one is cash. Okay, so when you want to measure cash, how do you measure your cash? Your cash is your cash. So there's no special measurement basis. It's cash. The money you have is the money you have. Just put it there as your money. The second one for financial assets is equity instrument of another entity. Okay, which is when you buy shares. And the third one is contractual right to receive cash. That's when you invest in debt. So those are the two we are going to focus on under financial assets. So I would start with equity, investment in equity. Okay. So this investment in equity here we are talking about is majorly when you buy shares in a company. But the one we are considering here is not the one that will give you significant influence or control or joint control. I know that Mr. Kazim has already started teaching you group account. And maybe you don't know before. Everything they are teaching you in group accounts, everything is around investment in equity. Everything. The thing is that investment now, that person has so much holding that he now has either significant influence that makes that investee to become your associate, or you have control that make the investee become your subsidiary, or there's a joint control that make the investee becomes your joint venture. That one is accounted for under either IAS 28, IFRS 3, or IFRS 10, or IFRS 11. Mr. Kazim is going to teach you that. What I am looking at here is when your holding is less than 20%, which I'm sure you must have called probably simple investment, right? But here is actually called financial asset, and it is governed by IFRS 9, and that's the focus here. So when you buy shares in your books, you initially measure it. I wrote it up here. When you invest in anything, just recognize it in your books at the transaction price. At the transaction price, which is the amount you invested. So if you buy shares of 10,000 naira, put it in your books at 10,000 naira. So maybe you bought 5,000 units of shares at 2 naira each. So that means in your books, you will have invested 10,000. So that's the transaction price. So when you buy shares, they are initially measured at the transaction price. Now, at the date you bought those shares, at the date of acquisition of those equity instruments, we need to understand why you have bought it. You need to understand your intention. Because buying shares is different from buying an item of PP or buying those other assets, like intangible assets. It's different because those other ones, we know if you buy a plant, for example, now, everybody knows that for it to be PPE, you must be holding it for either production or rentals or for admin. But when you buy shares, different people have different reasons for buying shares, but here we have narrowed it down to two. It's either you are buying it to hold it for the short term or for trading, or you are buying it to hold it for the long term. It's either of those two. Standard said that if you are buying it to hold it for the short term, the standard said you must classify that your financial assets, that investment, that financial asset, you must classify it at fair value through profit or loss. if your intention is you are buying it to hold it for the short term, meaning that you just want to buy it, and if the price goes up, you probably sell it. So that's buying it for the short term. But if you are buying it for the long term, then you should classify it at fair value to OCI. So from the above now, at the dates you are buying these shares, this financial asset, is either you are classifying it at fair value to profit or loss, which I shortened as FVTPL, that's fair value to profit or loss, or fair value to other comprehensive income. Is either of those two. That means that when you buy shares now, the way you will have recognized it in your books is you will credit your bank because you are parting away with money, and you're going to debit your financial assets, right? But you won't just call it financial assets. You would call it financial assets at fair value to POL or at fair value to OCI. So that when somebody looks at your books and they see that, this financial asset is at fair value to POL, then they will know that, okay, that means you have bought this financial asset purposely to hold it for trading. That is, if you see opportunity to sell at an higher price, you will sell. But if it is at fair value to OCI, a knowledgeable user will know that, okay, this guy is holding it for the long term, meaning even your children will meet it. Your children might even meet it because you are holding it for the long term. Now, I give an example of that, okay, if Wasiu PLC purchased 5,000 units of shares at 2 Naira each on 1st of January 2024, and I said, Wasiu PLC intends to sell the ordinary shares before the end of the year, how would this investment be initially measured and classified? Again, it will be initially measured at the transaction price, which is the amount you paid, 5,000 shares times the share price. And since he intends to sell it at the end of the year, that means he's holding it for the short term. So it will classify the investment at fair value to profit or loss at its intends to sell it in the short term. So hence, it will debit financial assets at fair value to profit or loss and credit bank. Okay, and that's that. Then I added something that if there is transaction costs like broker's fee, because when you are buying shares, usually you will use a stockbroker, and it's not for free. They will collect money from you. So that broker's fee, are you supposed to expense that, or are you supposed to capitalize that? So again, it depends. It depends on how you have classified the financial assets. So if you are classifying it at fair value to POL, meaning that you are holding it for trading, then any transaction cost should be expensed. But if you are classifying it at fair value to OCI, then any transaction cost should be capitalized. That's how you treat transaction cost. Then finally for today is subsequent measurement. Subsequent measurement, meaning at the end of the year, how do you measure these investments in equity at the end of the year? So again, the standard said that the measurement at the end of the year is either at fair value to POL or at fair value to OCI. Which means that if you have classified it at the beginning at fair value to POL, that means at the end of the year, you would measure it at fair value to POL. If you had classified classified it at fair value through OCI. At the end of the year, you measure it at fair value through OCI. And the big difference between measuring at fair value through P&L and measuring at fair value through OCI is usually where you transfer changes in fair value. Now, for example, now, this example I gave you, this guy bought these shares at 2 naira. You know that at the end of the year, the share price will not still remain 2 naira. It will have changed, especially if it's a quoted company. Share prices changes. So if the share price becomes 3 naira, for example, now, that means the value of these shares is not going to be 10,000 anymore. It's now 15,000. So that means in your books, it has to be now be recognized at 15,000. But there's now a gain of 5,000. That gain of 5,000, where do you put it? That is where the difference between fair value through P&L and fair value through OCI comes in. If you are measuring it at fair value through P&L, that change of 5,000, you take it to P&L. That is, you would increase your asset. That means you debit your assets to increase it from 10,000 to 15,000. The other leg of the credit will go to P&L. That is if you are measuring it at fair value through P&L. But if you are measuring it at fair value through OCI, that change in value of 5,000, you have to take it to OCI, other comprehensive income. And don't forget, anything that steps its leg into OCI will end up in equity. So that's just the difference between measuring at fair value through P&L and measuring at fair value through OCI. I'm going to stop here for today. Still on financial assets, I'll continue from debt instruments next week. So my hope is, I just hope that all these things we are teaching you, I hope you guys are reading it. I hope so. So just ensure that you read these ones that we have done, so that when we come next week, hopefully we are going to just finish it up, then so that we can move to some other things. In the upper week. The upper week, I am hoping to teach you IFRS 16 on leases. Then we'll see where we'll go from there as well. So let's close our class for today. So I'll see you guys next week. If you don't have any question, if there is, let's attend to that. If there is none, we'll meet next week. Okay, so let's meet next week. So bye-bye.
Bye.
Yeah.